Hello and welcome back, guys, in this second session of tiles from SPR's exam kit. So, what we've been discussing about is deferred tax is already done. So, we will be discussing about discontinued operation. Okay, so on 1st Jan 20x4, the shareholders had at a general meeting of the company authorized the directors of Tile to sell all of its holding of shares in subsidiary within the year. Okay, within the year. The tiles had shown the subsidiary as held for asset and discontinued operation at this date, right? So 30th April 20x4 it was held for sale. 30th April 20x5 it was discontinued operation. This made certain organizational changes during the year to 30th April 20x5, which resulted in significant additional activities being transferred to subsidiary. Okay, there was change. So the classification itself will be wrong because the asset was not available for sale, right? That is the evidence of this. The subsidiary has made significant losses in both 20x4 and 20x5. So since it will be classified as discontinued operation, so the profit will be reported below profit from continuing operations, right? So it might seem favorable in the eyes of investor. That's why they might be doing it. So we'll talk about that as well. First of all, let's discuss IFRS 5. IFRS 5 assets, non-current assets held for sale, right? Non-current assets held for sale and discontinued operation. Right? Mm. An asset or disposal good is classified as held for sale when where its carrying amount will be recovered principally through sale rather than continuing use. Right? So we know this definition already because we've talked about it many times, right? Continue use. So once this is done, so let's talk about criteria as well. To be classified as assets held for sale, the following criteria must be met. What are the criteria? The first criteria being is available for immediate sale in present condition and location. right? Second criteria is the management is the sale is highly probable. Management is committed to sale. It is likely that the sale will occur within next 12 months, and then there is active program to locate buyer, right? And should also be plan to locate the buyer and then market it at a reasonable price, right? Because it is market active program is there doesn't mean it's not a reasonable price. Reasonable price, right? So once this is done, so let's talk about discontinued operation. Discontinued operation is a component of entity that has been sold or has been classified as held for sale, right? And constitutes a separate major line of business or geographical area single coordinated plan to dispose the major line of business or geographical area. And then the last criteria will be basically subsidiary acquired exclusively for resale. Okay. Right. At disposal, group can exceptionally be classified as held for sale after a period of 12 months if certain criteria are met, such as circumstances arising that are previously considered unlikely, which were considered unlikely, right? And which sale prevented the sale from occurring. Sale from occurring, right? So in this case, what has happened? Basically, Tiles has made certain organizational changes, right? So that is the evidence that is not available for immediate sale. Tiles has made certain organizational changes during the year to 30 April 20x5, which resulted in additional activities being transferred to the subsidiary. Right? This also confirms that the asset was not available for immediate sale in present condition and location. At the date of classification. Classification itself at the date is wrong, right? That's what the evidence suggests. Furthermore, how much did the shareholders authorize? So they authorized it in 1st Jan, right? Shareholders authorization to sell the subsidiary was only granted for 1 year, and there is no evidence, no indication that it has been extended. This places there is doubt whether if the subsidiary sale is probable, right? Therefore, let's conclude. Therefore, the subsidiary should be treated as operations in the financial statement for both the year ended 30 April 20x5 and 30 April 20x4, right? This means that the subsidiaries loss will no longer be presented as separate as a separate line, right? As a separate line within the statement of profit or loss, and will instead be held within profit from continuing operation, or you could say just as treated as normal, right? Operations some of the assets and liabilities should also be classified from current to non-current. Right. Right. And that's pretty much it. So what about disclosure of bonus? What have they done? So it's a related party transaction, right? So they are trying to ignore that. So let's talk about, according to IAS 24, related party transaction party Transactions, not transactions, disclosures. Member of key management personnel is related to the reporting entity, right? And the standard explicitly states that directors are key management personnel. Right. Not operating, reporting. IAS 24 states that entities must disclose. Is it about compensation? Isn't it? Uh, Remuneration. Okay, so it's about compensation, and then why? Because of shareholders' wealth, right? That was the argument or point. That argument point. Say disclose all compensation paid or payable members of key management personnel, right? Therefore, files must disclose the bonus payable to directors, right? So let's talk about ethics. So what are the ethical issues that has arisen from this? Users of an entity's financial statements such as shareholders and employees rely on accountants to faithfully represent the entity's performance and position. Accountants are professionals who are endowed with status and are trusted, right? To ensure that this trust is not broken, accountants are bound by ACCA's Or you could say code of conduct and ethics, right? Code of ethics and conduct. This ACCA code sets out the importance of fundamental principles of integrity, objectivity, professional competence, and due care, confidentiality, and professional behavior. All right. Sorry about the mistakes. Faithful presentation associates associates compliance with accounting standards such as, let's talk about 12, IFRS 5, and IAS 24, right? Related party transaction. The directors have not followed the rules in this accounting standards, and thus the performance and position of files has been misrepresented. Does not represent the reality, right? So after that, let's give an example as well. For example, the recognition of the deferred tax asset has increased profit for the year. The incorrect classification, the subsidiary is a discontinued operation. Means that its losses are presented separately from the rest of tiles operations, and therefore is likely to be seen by the users as a non-recurring item. This suggests that the directors lack integrity and objectivity. So let's talk about related party transaction as well, okay? So what did they do? They did not want it to disclose it, right? Okay. Related party disclosures will impact the user's perception of an entity's past and future performance, as well as the success or failures of those who govern it. Right? After all, so they were giving this thing, right? This was the point, right? Because it would basically be a negative news which will decrease the share price, thus the shareholders' wealth will be reduced. That was the argument, right? So after all, excessive directors' remuneration is unlikely to be in the best interest of shareholders, right? Shareholders' wealth, and it will also be at odds, right? The directors' directors' pay is an issue that the shareholders have explicitly raised concerns about, and it would therefore seen that Tiles is trying to actively mislead the investors. This is in clear breach of ethical code and in some jurisdictions disclosures of remuneration is a legal requirement. So Tiles could be breaching could be breaching the company law. Therefore, the finance director's claim about the impact on shareholders' wealth she has a responsibility as a member of the accounting profession present to reality. Alright. Okay, so this is basically what we normally say. So if we even conclude, right, like saying what could be the actions, has the question asked about it. Discuss the ethical issues raised. So it does not talk about action, what the accountants should do or not. So otherwise, if they had basically told about action, so what we would normally do is the accountant would first of all report it, confront them, tell them this is you are clearly violating the ethical code, and then if they don't agree on it, then go to your next uh, non-executive directors, let them know, and even if then if they don't do anything about it, then what we normally do is we seek an advice from ACCA ethical helpline. Okay, that's what the course of action would be. Okay, so this is how we basically answer this question. So I will see you in the next question regarding Guardian, question number 20. So if you have any questions until now or anything regarding SPR, please do comment down below. I'll be happily willing to answer your questions. So I'll see you in the next question. Bye bye.